So guess what? I have some index cards that I made, put together, just to allow me to be able to get the terminology of options trading. So that way, um, at least know what I'm talking about. I know what's being said. I know how to read the contract. I know how to read the market, the analysis. I know how to read risk. And I look on YouTube, I don't really see a lot of people doing this. So what I want to do is basically show you this method. I'm using the oldest methods in the book, which is writing things down. Everything is so digital, we forget that maybe seeing everything on a screen doesn't help you absorb psychologically, physically, the other senses that account for learning, especially a skill like this, a life changing skill. So, yeah, let's get to it. I'm gonna talk about risk management. What I'm gonna do is just show you the card and read it off. We're in class. This category is risk management, okay? So in risk management, you have risk reward ratio, okay? Risk reward ratio, which is a way of assessing potential returns that you stand to make for every unit of risk. For example, if your risk is $100 and you expect to make 300, risk to reward ratio is 1 to 3 or 0.33. Position sizing, determining how much money to spend on each trade. Margin call, a broker's demand that an investor who has borrowed money to buy securities must deposit more money or securities into their account so it's brought up to a minimum value. Margin call. Leverage, okay, allows investors to control a large position in a stock with less capital, potentially increasing returns. Hedging, an investment that helps mitigate the risk of the existing position. Portfolio diversification, that's self-explanatory, it's having more than one stock. The practice of spreading your investments around so that your exposure to any one type of asset is limited. Speculation allows traders to gain longer short exposure to stock without the need to fully invest the stock. Pin risk. Put a pin in that. The uncertainty an options contract writer faces when the underlying asset price closes at or very near the strike price at expiration date. So that are your risk management. Pin risk, speculation, portfolio diversification, hedging, leverage, margin call, position size, risk reward ratio. I'm gonna go to the second stack of flashcards. This is just basics, okay? Just basics. So you have a call option. A buyer has the right but not the obligation to purchase an underlying asset at predetermined price before a set expiration date. Buy call option, expect assets price will rise. So call is for a what chart? What movement? What direction? Contract size. The deliverable quantity of a stock, commodity, or financial instrument that underlies a futures or a options contract. Premium. An option premium is the fee that the buyer of an option contract pays for the right to buy or sell stocks at preset price when the contract time limit expires. Options contract. A contract giving the buyer the right but not the obligation to buy in the case of a call or sale in the case of a put the underlying asset at the specific price or in or before a certain date. Expiration date. A specific date and time an options contract expires. Self-explanatory. Strike price. Yeah, strike price. Okay, a fixed price at which the owner of the options can buy in the case of a call or sell in the case of a put the underlying security or commodity. So this is the predetermined price or in the money. And let y'all see that one. Put option. So remember we had a call option for what kind of chart? Here's a put option for a bearish chart. Put comes from the fact that the owner has the right to put up for a sale. Put contract gives the owner the right to sell underlying assets at a set price or strike price before a certain date or the expiration date. European options can only be exercised at the expiration date. So that means is if their due date is in a month, that's when they can buy or sell, call or put. But American options can be exercised at any time prior to expiration. LEAPS. Long-term equity anticipation securities. These are publicly traded option contracts with the expiration dates that are longer than 1 year. In the money. Now, these three right here, at the money, out of the money, and in the money, are very important when you're trading options, because this is where you put your limit. This is where you set your limits. And these all are determined on your Greeks and your limit. So the limits vary if you're going to sell, or if you're going to put, or if you're going to call, or you're going to buy. So that will determine you're in the money, at the money, and out of the money. So the at the money is literally in the middle of the stock price that is equal to the strike price. At the money. Out of the money is less expensive, similar, a slimmer expiration date. So out of the money is like tomorrow, like the contract was expired tomorrow, or today, the day I'm placing the trade. Out of the money options are not considered to be profitable to exercise it right now. You believe that it's not yet reached its strike price. And in the money with a put or a bearish or a put or a Yeah, I was gonna say sell. So you buy a put and you sell a call. That's what I was trying to say. I'm doing 5 different classes at once. So put in the money is when its strike price is greater than a reported level of the underlying assets. And your call in the money is when the strike price is less than the spot price of the underlying assets. So this is the way I put it on here so that I can remember it. The color of the candlesticks usually indicate the direction of the traffic of the chart. So let's recap. This is basics. These are your basics. In the money, out of the money, at the money, leaps. This is American options and European options, put options, strike price, expiration date, options contract, premiums, contract sizes, call options. Are you tired yet? We're just getting started. I'm sure. Halfway there. This stack, which is trading, executions, and orders, and then to close it off, we'll have market analysis techniques. Okay, and that'll be my time for tonight. Trading, execution, orders. So there's an order book, which is a list of trades, either electronic or manual, that an exchange uses to record market interest in a specific security or a financial instrument. Block trade. A single purchase or sale of a large volume of financial assets. It's a large privately negotiated securities transaction. Quote, this is the last price at which the asset was traded. So this is my example of what you will see when you're looking at a quote. Rolling options. Closing an existing option position and opening a new one, typically within a different expiration date or a strike price. Bid-ask spread. The difference between the ask price and the bid price for an asset in the marketplace. Liquidity. The ease with which traders can buy or sell option contracts without causing significant changes to the contract's market price. This is the limit order. Okay. Limit order. An order to buy or sell a stock with a restriction on the maximum price to be paid, or with the buy limit, or the minimum price to be received within the sell limit. Stop loss, order loss. Designed to limit an investor's loss on a position by triggering a sell when the market turns against you. This is important. This probably should have been in risk. That and limit order. These two should have also been included in risk management. Market orders. An order to buy or sell a stock at the market's best available price. Execution. When the buy or sell order gets filled. So this is like when your text message is sent out and then it says delivered, or somebody texts and you don't know if they got it yet until it says read. This is execution. So you place the order it's going through, it's ringing, the phone is ringing, but when it's executed, somebody picked the phone up or they sent the voicemail. Better way to look at it. Okay, let's recap. Trading, execution, and orders. So, execution, market orders, stop loss orders, limit order, liquidity, bid ask spread, rolling options, quote, block trade, order book. And finally, and then I'll let you guys rewind this a bunch of times and take notes because you want to be a millionaire trader. Market analysis techniques. So this is how you look at what's going on your charts. You want to be able to look at this and use your candlesticks to understand what type of trade you're about to enter. So you want to look at your charts. Okay. This is what market analysis terminology looks like. So, volume, the number of contracts that have traded since the market opened for the day. Volatility index, which is the VIX, the annualized implied volatility of a hypothetical S&P 500 stock option within 30 days to expiration. So this represents the market's expectation for the relative strength of the near-term price changes of the S&P 500 index. Sector analysis, a statistical analysis of the state size, demographic, pricing, competitive, and other economic dimensions of a sector of the economy. This is open interest here. The number of outstanding option contracts traded but not yet liquidated or closed by either an offsetting trade, exercise, or assignment. Fundamental analysis, a method of evaluating the intrinsic value of an asset, analyzing the factors that could influence the price of a future. Stay with me, people. We got two more terms. Two more. Technical indicators, a method of analyzing and predicting stock movements based on past market data, price, and volume. Chart analysis. Think about everything. A method. A methodology. Y'all, it's 3 o'clock in the morning. Okay. A methodology used by traders and investors to make decisions in financial markets. Chart analysis. Recap. Okay. Here we go. Recap of market analysis techniques. Chart analysis, technical indicators, fundamental analysis, open interest, sector analysis, you got this, volatility index or VIX, and volume. You did it. Good job.